Okay. So today we're talking about seller financing. It's going to be a quick primer on it this early morning, this early Tuesday morning. I hope everybody has some coffee. I certainly do. We're going to start off, of course, because I'm an attorney with a disclaimer that I am providing information but not legal advice. And a little bit about my office. I can know most of you, of course, but I've been an attorney for 20 years now, real estate for 15, and I am just now the past chair, actually, of the NABOR Legal Resources Committee. So expect to see some tweaks coming up here in the next year as we modify the contract, and it's a revision year. And we're going to dive right in this morning with seller financing. We're going to talk about what is seller financing, why seller financing, and some pros and cons for the buyer and the seller. Then we'll talk about the law, the Dodd-Frank Act, which is federal law. And then we'll review the NABOR and FARBAR addenda that cover seller financing, and we'll take all your questions. Of course, anytime you can always unmute yourself and ask a question or put your questions in the chat. I've got it up on my screen so I can see it. And let's just dive right into seller financing and what is it? Well, it's where the seller becomes the lender. Sometimes called owner financing, sometimes it's called a purchase money mortgage, but it is where the seller becomes the lender. And it's an interesting concept because if you're from up north, you might be aware of a deed of trust where title does not transfer to the buyer at closing but goes to the lender. In Florida, we use mortgages. So title transfers at closing to the buyer. The seller takes back a mortgage from the buyer and they get paid over time. It's not a land contract. It's not a contract for deed. Those are disfavored in Florida. You have to foreclose on a land contract or contract for deed anyways. So seller financing is the much preferred method for dealing with buyers who don't want to go the traditional financing route. Also, it's not a purchase option, but an actual purchase. So I've had the question, can I sell my property and then take back a mortgage and then they can have an option to buy it all later? Well, no, that's not how it works. You actually are going to close, there will be title and everything done at closing, and the seller gets back a mortgage. So why would you do seller financing? Well, let's mute these. Why do seller financing? If a buyer can't qualify for traditional bank credit, commission salespeople, few people I know are commission sales folks, realtors, independent small business owners, which all of you are. You may have difficulty getting traditional financing because you don't have regular income and W-2 wages, which is what the 30-year mortgage is kind of set up for. Sellers can earn better interest if they don't need the cash from the sale. And of course, there's lowered transaction uncertainty for both parties. Typically in the standard contracts, you have 10 days to figure out the credit, and then you move on, either go to closing or you don't. So let's talk about some pros and cons for the buyer. First of all, lower closing costs. Lenders typically charge 1, 2, sometimes 3%, depending on points on the mortgage. So there would be much lower closing costs. There's a faster close because you don't have lengthy underwriting. The lender is the seller. The seller should know the buyer or be reasonably comfortable with the buyer's credit, but usually it's not the same process as bank underwriting. And you can extend the amortization schedule. You have more flexibility so that you would have lower payments, assuming you're going to have a balloon at some point, though. What is difficult for the buyer? Well, the buyer's got to work with the seller, so you have to like the seller at some level. The seller's going to know your credit information and financial history if they do a background check. And you are going to have to refinance if the seller insists on there being a balloon payment. So you weigh these back and forth, and the seller's got to be happy too. Talking about pros and cons for the seller, they're going to get a good interest rate. Interest rates are high right now. Typically, seller financing, the interest rate is going to be higher than your commercial rates, just because closing costs are less, so your APR is going to be lower. The seller will be made whole. The banks won all the major court cases in the foreclosure crisis, so there's very little risk to a seller about not getting paid. Either they will get paid or they get the property back, and there's not going to be any lender required repairs as there might be in, say, a VA loan situation. So again, for sellers, it's a good deal as well for buyers. The only issues for sellers are they do have to foreclose if they don't get paid. But foreclosure in Florida is not hard anymore. It was hard. It was very hard for a long time. But like I said, the banks have won all the court cases. So um, foreclosure may take a year, but that is, again, the seller will be made whole by the court system. So the one thing that sellers do have to do is they have to hold the original documents for the life of the loan. So you can't lose that promissory note. That's a really big deal. You must have the original promissory note or the foreclosure is going to be much harder. And then, of course, there are limitations under federal law, the Dodd-Frank Act, that limit your financing options. So let's take a few minutes and talk about Dodd-Frank. It's the federal banking law that controls seller financing. And what is Dodd-Frank? It just limits the situations in which seller financing may take place. Um, and anyone who offers or negotiates terms of a residential mortgage under the act has to be a licensed mortgage originator. Of course, that doesn't make sense if you're a seller to become a licensed mortgage originator. There are two exceptions that we're going to talk about. First of all, the act applies to residential loans where the buyer will live in the residence, and it includes all types of dwelling units, houses, apartments, townhomes, condos, of course. It does not apply, the Act Dodd-Frank does not apply to vacant land, commercial property, or investment property. So if you sell a lot of rentals and you want to do seller financing, then you can do seller financing as often as you want, and Dodd-Frank would not apply. Big loophole for seller financing: if the buyer is a corporation or an LLC or any really entity, then the act does not apply, and you can do whatever you need to do to get the seller financing done. So we've done that in a lot of cases. We'll have the buyer take title in an LLC. Oops. But that can mean higher insurance costs and carrying costs for the buyer, although typically those are outweighed by the benefits of seller financing if the buyer really wants the property and can't get commercial financing. So if you violate Dodd-Frank, then you may have a problem as the seller because you'd be unable to enforce your loan, and the borrower has the right to sue for violations and be reimbursed for their attorney's fees and costs. So it can be quite onerous on a seller who doesn't comply with the act. So what are the two exceptions to the act that I mentioned earlier? Well, there's the one property exclusion and the three property exclusion. And these are where 99.9% of your seller financing deals are going to fall, is in the one property exclusion, where the seller is not in the business of selling properties. They simply have a property that they're selling to a child or a neighbor or a friend or some type of relative, and that they just want to make the transaction easy, so they're going to do seller financing. The seller doesn't need the money. So in the one property exclusion, first of all, the seller has to be a natural person, estate, or trust. So you cannot make a loan from a corporation, which means the property needs to be in the name of the seller. You can do this one time in a 12-month period. So the seller cannot repeatedly buy and flip houses with seller financing during a year. And they have to have owned the property that's being sold, which will be the security for the financing. So again, seller has to own the property in their name. And they cannot be the contractor who built the property. If those things all meet up, then the loan must not have a negative amortization feature, which means that when you pay interest, the balance goes down, not up. Not have a balloon payment due in less than 5 years, although we see this violated quite a bit. People like 3-year balloons for some reason. Have a fixed interest rate or adjustable rate that is adjustable after 5 or more years, so you can't just do an immediately 1-year ARM. And then it's limited in how much it can adjust. And the nice thing about the one property exclusion for under Dodd-Frank is that you don't have to comply with the ability to pay rules, which means that the seller does not have to figure out if the buyer can actually afford the mortgage, although I think common sense tells us that's a good idea, that we want to make sure the buyer can repay the mortgage, but you're not required to go through the ability to pay rules like you would if you were a commercial lender. Now, the other exclusion from the act is less used, but more comprehensive. It's the 3 property exclusion. Again, the same criteria apply for the one property, but you also have to comply with the ability to pay rules. Under the 3 property exclusion rule, you can sell up to 3 properties in a 12-month period. The seller can finance 3 properties in a 12-month period, but they got to make sure that the borrower can pay. And then, of course, the loan can't have a negative amortization feature. It cannot have a balloon at all, so you can't just get paid later. And then it has to have a fixed rate or adjustable rate of interest that doesn't adjust for the first 5 years. And then a little different under the 3 property rule, the seller has to determine that the borrower has a reasonable ability to repay the loan, which means you're going to look at their credit, you're going to look at their income statements, make sure they can afford the payments, and then you're going to want to make sure that they're documented. So you'll want to keep a file on your buyer. And you don't have to formally document everything, but you really should keep a record of your analysis. And I would get a credit report and look at tax returns so that you have third-party records available and not just something from the buyer saying they can afford the loan. All right, before I get into the contracts, does anybody have any questions on Dodd-Frank? Okay, I'm not seeing anything in the chat, so let's keep moving. Let's talk about financing under the FAR-BAR. These are what the terms agreed to in the rider. So rider C is your seller financing rider under FAR-BAR, and it's got some interesting features. It does not include a time frame for the buyer to provide the financial information to the seller or for the seller to approve or decline financing. So you're going to want to negotiate that, make sure the buyer timely gets their information to the seller and that the seller makes a decision about seller financing as quickly as possible so we know if we have a deal. So that's something you'll add to additional terms in the FAR-BAR contract. It does not, the seller financing does not include a clause allowing for termination if the seller financing does not comply with Dodd-Frank. It's kind of assumed that there will be a termination if the seller can't comply with Dodd-Frank. Although why would you enter into a contract that you couldn't comply with in the first place? And as I'm going to show you, Dodd-Frank's qualifying information is actually on the face of both the FAR-BAR and NABOR contracts. So you should know this up front. And it does not prevent assignability. So that's an interesting thing. The FAR-BAR rider does not say that the buyer cannot assign the contract, which means you get a situation where seller financing is approved and then the buyer may assign the contract to somebody else. So make sure you check the box in the FAR-BAR contract that says no assignment if you're going to do seller financing. That's in the main FAR-BAR contract. And then, of course, there's the ability to choose an adjustable rate mortgage in the FAR-BAR contract, and there's a place to fill that in. let's look at the terms of the FAR/BAR contract. So this is the a screenshot of the form that you'll fill out, and you pick a first or a second mortgage. You pick the principal amount, the interest rate, and then you pick the payment terms. And the payment terms, this is pretty much all that's allowed under Dodd-Frank. So you can't go outside these terms. You can do a fully amortized loan. You can do interest only. You can do a balloon, but then you can only do it for one property exclusion. You can do an adjustable rate, but then you've got to pick about when it adjusts and how. And then you get into how the payments are made. Are they going to be monthly, quarterly, or annual? You calculate the payments using an amortization schedule, which you can find online. If you Google amortization calculator or mortgage loan calculator, you'll get dozens of calculators to help you figure out the payments. And then, of course, when the first payment is due. And then this is the balloon, when the balloon payment is due. So I would go get yourself a favorite online calculator, shoot me an email or a text. I can send you a link to one that I use. There's some great ones online. And then the FAR/BAR note and mortgage terms are determined in the contract already. First of all, if the seller is a second mortgage, which happens sometimes, but not as often, then a default of the first mortgage is a default of the seller financing. There can be no prepayment penalty. You can do acceleration. So if the buyer sells the property, they have to pay off the mortgage. The buyer has to keep the property insured. Remember, we said if the property's in an LLC and you're trying not to comply with Dodd-Frank, then insurance is going to be more expensive, so be careful there. The seller, what they're allowed to ask for in the loan agreement itself is limited to what's generally used in the county. And then you get a 30-day grace period in the event of default. That's a long grace period under FAR/BAR. Typically, it's 10 days or 15 days. So be careful there. You might want to modify that. And then you got to pay your taxes and your association dues under the FAR/BAR terms, which of course any lender is going to require. And personal property or leases being conveyed are subject to the lien and security interest at the option of the seller. So that's the FAR/BAR's basic terms. I be honest, I'm not a big fan of the FAR/BAR financing terms. I think that I'm going to show you the NABOR terms here in a minute. I think you're going to find them more favorable, and it's a cleaner transaction under the NABOR forms. But again, they're both completely modifiable to what we need to do under Dodd-Frank. So don't worry about it too much. If you are used to FAR/BAR contracts, I'll help you get through the process. So NABOR seller financing, there's an addendum for that, like there is for everything else in NABOR land. The buyer has 5 days under NABOR from the effective date to provide the seller with their credit and financial information. So we can pull a credit report, look at tax returns, see your W-2 wages, things like that. And then the seller has 5 days to make the financing decision. So we know under NABOR within 10 days if we're moving forward. And if the buyer is not declined for financing within the 10 days, then the seller's moving forward. Interesting, the NABOR contract addendum has a termination clause that if they don't comply with Dodd-Frank, then if the seller figures out they can't make it work, or the buyer figures out they can't make it work, then you have 10 days to terminate. And if you don't terminate, then it's a warranty under the NABOR contract that the seller is in compliance with the act. So that can be a big deal if the seller is not in compliance with the act and the buyer tries to terminate the loan. So NABOR's got a lot more terms than FAR/BAR does for what's going to be in the note and mortgage. First of all, the Similar to the FARBAR under NABOR, the default of the first mortgage is a default of the second mortgage. I said that badly. If the buyer defaults on their first mortgage and they have seller financing for their second mortgage, it's also a default. There's no prepayment penalty. They do allow acceleration if the buyer defaults. The buyer has to keep the property insured, and the seller gets copies of the insurance policies, which is a big deal for sellers in case there's an accident. Again, customary terms. This one, the NABOR contract specifies that there's a 5% penalty if the mortgage payment is more than 10 days late. That's pretty typical for commercial financing. So that's more in line with your standard mortgage. Buyer's got to pay the taxes and provide proof. There's a due on sale clause, which is similar to an acceleration clause in the FARBAR. The buyer has to prepare the note and mortgage and furnish it to the seller within 15 days, so we get the documents ready. And the buyer pays for the preparation of the documents. So let's talk about the NABOR payment terms. When I say documents, I mean the lawyer fee for the mortgage and the doc stamps and everything else. NABOR's payment terms, much simpler, much less flexible than the FARBAR, but again, it covers all the major terms. I think it's a little better. You put the amount of the seller financing here in this blank. This by the way is a snippet of the NABOR seller financing addenda. You pick whether it's going to be a first or a second mortgage. Usually it's a first. You put the interest rate here. How long is it going to be amortized? Typically, you would put 30 years here because you want a low payment. So I generally counsel buyers and sellers, even if there's going to be a balloon, to do a 30-year amortization to keep the payments low. And then if there's going to be a balloon, check this box and enter the time for the balloon here. Remember, it's got to be at least 5 years. So that's 60 months. 60 months. And then, or it will not have a balloon feature and it will be fully amortizing. Then the buyer decides the frequency of the payments, whether they're going to be monthly, quarterly, semi-annually, or annually, and then whether it's going to be principal and interest or interest only. I think this is a great feature if you're going to do an interest-only loan, and then you're going to do a balloon after 60 months. You can do that. The buyer has an opportunity to build credit, maybe pay down some principal. Questions about the NABOR or FARBAR contracts? Seeing none. Okay. So just in conclusion, seller financing is great if the buyer and seller can get along. If the buyer and seller get along and the seller doesn't need the cash, I think seller financing is a wonderful instrument for both parties. It lowers transaction costs. It speeds up the closing. You just need to understand the Dodd-Frank rules so that when you're talking to your buyer and seller about it, you don't have to worry about whether you're in violation of federal law. And I'll say this as a final thought before I answer questions. I love seller financing. It's easy, it's quick. And if you have any questions about it, I'm happy to talk about it. Just give me a call. Helen is asking, can the buyer write 12 months balloon payments? Helen, I'll tell you what, I see 12-month balloons all the time, but the Dodd-Frank Act really does say 60 months. So be very, very careful there. Mike is asking, do HOA and condo associations have approval of seller financing? Not typically, Mike. They typically don't approve seller financing. They would approve the buyer in the normal course. And then they really, I've not seen an association look at seller financing yet. Maria is asking, can a seller have an AOB? I'm assuming that's an assurance assignment of benefits. Maria, you can no longer do AOBs in Florida. They changed the law at the beginning of this year. And Mike, what's the attorney cost to set up seller financing for a client? Mike, I charge $450 paid by the buyer to do the loan documents. If you think about it, typically the origination charges are 1 or 2% of a loan, and I'm charging $450, so it's a great deal for both parties. Okay, Michael Swanson. I've done seller financing in another state where the seller paid taxes added to the principal each year. This also changed the payment amount. Is that possible in Florida? Yes, you can absolutely do an escrow for taxes and insurance in Florida. We do that all the time. It would change the monthly payments based on the escrows, Mike. But that's totally doable. You would just set that up in the loan agreement. Bob is asking who services the loan. Bob, that's worked out between the buyer and the seller. There are professional servicing companies that you can engage, but they cost money. Typically, the buyer sends the seller a check every month and it just goes along swimmingly. If you wanted a professional servicing, such as for some, if you added your HOA payments and your insurance payments and your tax payments, and you wanted it professionally serviced, you can certainly do that. It just adds costs. Can you add a payment to the escrow? Yes, Loretta, you can add payments for insurance and HOA and taxes to your monthly payments. Okay, any other questions? You can unmute yourself or put them in the chat. Give people a second. Anything? All right. Oh, yes, Maria. If you escrow it, then the seller would make the payments. If you have an escrow for payments, then the seller would make this tax and insurance payments on behalf of the buyer. All right, so I like to keep these morning ones short. I want you guys to have an awesome day. Get out there and sell some real estate. If you have any questions, give me a call anytime. My contact information is here. I love talking to you all. Have a happy holiday and take care. Good luck, everybody.
Thank you.